In this video we are going to analyze Qyld. So before starting this video, please like this video and subscribe to our channel for future updates. Today, I'd like to address the arguments for owning Qyld and offer my thoughts on the fund. I previously compared the fund to two closed-end funds in the technology sector. People have told me that those investment options don't meet their Qyld objectives. That's all right. Let's take a look at those objectives. People invest in Qyld for one of two reasons, as far as I can tell. The first and, in my opinion, the most important niche that Qyld fills in investor portfolios is that it provides immediate income. It was dubbed a bond substitute by some. I take that to mean that in this era of low fixed income dividends, they look for income in funds like Qyld. I dislike the term bond substitute in this context because bonds serve more than just as a source of dividend income in a portfolio, but that's a topic for another day. Qyld is viewed as being similar to a bond in that it provides income, though, unlike a bond, the income varies from month to month, with little to no expectation of capital gains. It's easy to overlook the fact that a bond will fully return your capital, whereas Qyld is unlikely to ever do so. Let's take a look at how well the fund has performed as a bond substitute over the years. Since inception, these graphs show distribution rates and fund price. The average yield over the last 12 months has been 12.0%. As one might expect with such high yields, the income bonanza has come at a price in terms of capital value, as shown in the lower chart. The fund has lost -10.2% since its inception. However, the fund was taken over by a new team in January 2019, and it has remained flat, plus 0.7% since then. Investors flock to Qyld because of this track record. Clearly, the fund achieves its goal of high income generation. A second group of investors has a completely different goal for Qyld. As the comments on the previous article indicate, some people see it as a way to build a future income stream, such as for a planned retirement. Their argument is that by reinvesting the high distributions back into the fund, one can increase the share count and own more of the high-yielding asset when income is needed. In essence, they are investing in the fund for the long term. Not that they would call it that, but that is the foundation of their strategy. They are currently accumulating capital in preparation for future income from the fund's total return. The first group of Qyld investors can point to the income graph and claim that the fund is performing as expected. I may not agree with those objectives, but I will not argue that they are not being met. This is not the case for the second group of investors, those who are accumulating capital in order to generate future income. Qyld is a terrible vehicle for that purpose. How does Qyld work? The strategy used by Qyld to achieve those double-digit yields is simple. To replicate the NASDAQ 100 index, NDX, the fund holds all of the stocks in the index. Because the index cannot be bought or sold, I'll use the Investco QQQ NASDAQ 100 Index ETF, QQQ, to represent an investable substitute for the index in these comparisons, as both Qyld and QQQ passively track the same index. The index, on the other hand, can be used to buy and sell options. Writing calls on the NDX generates distributable cash for Qyld. The company's portfolio holdings cover the calls. Index options, unlike the covered calls that many people use for income, do not require the transfer of the underlying assets if they expire in the money. Index calls are settled in cash. Each month, Qyld's calls are written at the money with an expiration date the following month. Premiums for at-the-money calls are high, but if the NDX rises at all during the month, those gains become liabilities for Qyld. The fund has a negative cash flow on the option if the index gains more than the premiums it has received. The index gained nearly 10% in last month's option month. I'm not sure what the premiums were, but they were unquestionably lower than the 10% increase. The calls are covered by the index components held by the fund. If NDX falls in value, Qyld's portfolio value falls as well. All of this means that Qyld is effectively built to avoid capital gains. The option premiums provide a return to the company's investors. Other covered call, also known as buy-right, funds take a different approach to their option strategy in one of two ways. Some people make calls with their own money. This provides some capital growth opportunities for those funds, but it also means lower premiums and, as a result, lower distributions. Qyld's management has chosen to maximize premium income while limiting capital growth. While some, like Qyld, write calls on the entire value of their portfolios, others only write calls on a portion of their portfolios. Again, this allows for capital growth while limiting the amount of income available for distribution. Volatility. The goal of many option-based funds is to lower volatility, here again, at the expense of long-term gains. Funds that use a collar strategy, which limits both upside and downside risk, are prime examples of this approach. Nationwide Risk Managed Income ETF, NUSI, and Eaton Vance Risk Managed Diversified Equity Inc. Fund are two such funds, ETJ. These are not the same as Qyld. Upside and downside capture ratios are a good indicator of this. Total return ratios are calculated using a single, consistent market benchmark, in this case the S&P 500. For upside capture, the category average is 51, and for downside capture, it's 57. This means that the average option-based fund will only capture 51% of the benchmark's upside gains and will lose only 57% of the benchmark's downside losses. The upside ratio for Qyld is 69, while the downside ratio is 78. As a result, while Qyld does reduce market volatility, it does so by slashing market gains rather than fending off market losses. The upside-downside ratios of QQQ, which holds an identical portfolio, are a useful comparison. The upside ratio for QQQ is 119, while the downside ratio is 90. A closed-end fund with a strategy similar to Qyld, QQQX, has an upside ratio of 86 and a downside ratio of 88. Readers interested in Qyld as a low-volatility alternative to the NDX should think about the implications of those two sets of ratios. Once again, Qyld's strategy sacrifices upside potential. However, as these figures show, it does not provide adequate protection against losses on the downside. The fact that QQQX also performs poorly on these metrics suggests that this is a trade of covered call funds, which is a question worth exploring further. Drawdowns. Although an option income strategy might be expected to limit drawdowns, the maximum drawdown for Qyld was -16.64%. In comparison, QQQ was down -17.04% over the same time period. Those figures, however, only tell part of the story. Since its inception, Qyld has been in a state of drawdown. The fund has just over 8 years left. It has demonstrated in that time that it is capable of generating high income. However, this graph demonstrates how significant the cost of Qyld's high distribution is. The at-the-money covered call strategy, as I mentioned earlier, leaves no room for capital gains. It also does little to mitigate losses, as shown in this graph. It's also worth noting that the drawdown's depth follows QQQ's pattern. Some believe Qyld's option strategy means the stock is uncorrelated with its holdings. Of course, this doesn't add up, and the numbers back it up. For the past 2 years, the correlation coefficient for Qyld, QQQ has been 0.9, and 0.87 for the entire sample since December 2013. Summary. Qyld is owned by people for 2 reasons. Those who invest in the fund for the high current income it generates should be pleased with its recent consistency. They should not, however, have any illusions about the long-term viability of those high yields. Since its 3rd month of existence, the fund has been in a drawdown. The magnitude of the drawdown fluctuates, but the long-term trend is downward. As we've seen, Qyld's call writing strategy isn't up to par with even one of the funds that employ comparable option income strategies. The second group, which I believe is much smaller than the first, is enchanted by high income as a means of capital accumulation. Reinvesting the income into the fund, they argue, will increase the number of shares in the fund, resulting in higher retirement income. The pursuit of total return is irrelevant to adherents. What matters is increasing share count. What they don't realize is that this is a total return strategy. When the income is needed, the capital can be moved into the income-generating asset, regardless of the path taken to build capital, total return. Investing in Qyld's passive index, via QQQ, without regard for how much or how little income is generated during this capital building stage would have resulted in a fourfold increase in income. What are your thoughts on our video? Have you invested in QYLD ETF? Please let us know in the comment section below. If you enjoyed this video and would like to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.